I didn't come prepared to talk about this, but this is something I was fooling around with for comparison's sake. This does happen to be, the same age, 35-year-old male, right? And this is a whole life policy. And the premium is significantly higher, for sure.
5 times roughly, right?
This is why, typically when we're talking about, again, we're looking big picture. We're not here to sell whole life. We're here to solve your problems. We're here to educate you and optimize your overall financial picture. Okay. So for most people, you're not going to solve for your full death benefit need with a whole life policy, right? For most people. So usually it ends up being a blend of convertible term and whole life, right? So we're not against term at all. Okay.
No, definitely not.
Convertible term is a great solution. I love it. It's a great solution. It's not a permanent solution, but it's a great solution. So again, we're making distinctions. Term and convertible term, in my opinion, are in two completely separate categories, right? Convertible term with a company that has a competitive whole life product is a great, great solution. Gives you so many options, keeps all your options open. Whereas non-convertible term, or term that's convertible with a company that doesn't have any good whole life product, I just don't see I don't see why you would do that when for roughly the same price, maybe a little bit more, not much more, you could get a convertible term policy that actually puts you in the right position to succeed, right?
Right.
I think one term versus convertible term versus non-convertible term, the difference in premium is like $20.
Sometimes it's even the same, right?
Yeah, exactly. So, I don't understand why if you're going to get term, at least get convertible term with a good whole life company, right?
Yeah, I mean, it's kind of like if you're going to the car lot and there's 2 cars and it's like the same model, and they're telling you that you can get the upgraded features for the same price or close to it. Why would you not take the upgraded model, right? It's like a no-brainer. It's kind of the same
Yeah.
thing.
That conversion privilege is huge, right? It puts it in a whole nother class, right? Having just pure term is sort of like just renting the death benefit. Convertible term is the rent to own option, right? You're renting it, but you have the option to own it anytime you want, as long as that term is enforced, no matter what has happened to your health.
Yeah.
Right. Okay. So in this particular one, you can see we're paying a $10,000 premium and we have a $781,000 death benefit. So it is more quote unquote expensive if you're myopically focused on what's the premium versus what's the starting death benefit, right? That is only a tiny fraction of the overall picture, right? So much of this is not, so much of what makes whole life great is not contained in the whole life insurance illustration, right? Okay, it's like looking at an architectural diagram of a house. Well, that doesn't really give you the full picture of what that house can do for you, whether it's a rental property, whether it's a place to live, right? It doesn't show you how you can leverage it by borrowing against it, how you can upgrade it, all the tax benefits you get from owning real estate, all that stuff, right? Okay. So now notice, I'm going to say we pay $10,000 in premium in the first 3 years, okay? And we have, at the end of year 3, we have less than $5,000 in cash value. Let's just assume it's zero for the moment, okay? So basically you paid in $30,000 over 3 years and you have a $781,000 death benefit. Okay, so let's consider that $30,000 a sunk cost. Okay, sunk.
And this is a pretty plain Jane whole life policy.
It is. Yeah.
Yeah.
We can design this a whole bunch of different ways, right? So
Yeah.
that's the other thing about whole life is you can't treat it like it's an amorphous blob. I can design this so many different ways. Okay. So this is just an example. But everybody, that's the other problem. That's why I hate showing numbers, because as soon as you show numbers, people just get focused on those numbers. No matter how much you tell them, look, there's just an example. I constructed it a lot of different ways. They conclude it's just gospel because they don't understand the structure behind it.
Yeah,
So
that's why I
they
just
draw
wanted
wrong conclusions from it,
that's why I just wanted to say this is plain Jane whole life. Doesn't mean this is
Yep.
bad. It depends what you're looking to accomplish, right?
Yep. And I'm trying to do this because I'm trying to set up the weakest possible case for whole life and show you how even in that case, it still looks pretty darn good, right?
Right. Yep.
Okay. So let's consider that a sunk cost. You paid $30,000 over 3 years and you got a $781,000 death benefit. A lot more expensive than term. Sure. Okay. But Peter, that's all you have to pay. That's it. You're done. You paid $38,000. You paid $30,000 and you're now worth $781,000 when you die. That's it. But wait a minute, Peter. We have to keep paying this $10,000 premium for a whole life. Look at this. We got to pay $10,000 every year to age 100. What are you, some kind of scam artist? You trying to rip me off? I got to pay this premium the whole time. Clearly, I'm just a liar, Peter. I'm just trying to try to scam people, aren't I? Well, okay, hold on. Let's dig a little deeper. In year 4, you pay in that $10,000 premium. You have $14,000 in cash value available to you. Is that a cost? You pay $10,000, but you have $14,000. Is that $10,000 a cost to you?
I don't think
Let's
so.
look at year 5. You pay in that $10,000 premium and your cash value grows by $12,000. So Peter, if you pay me $10,000 and I give you $12,000 back immediately, was that a $10,000 cost to you?
Nope.
And every year after that gets better. Let's look at year 20. Oh no, I'm still paying this premium. Why would I want to do that? Because the premium's not a liability.
Yeah, now you
You're
got
putting fuel. You're
280,000
putting
cash.
fuel. Yeah, you're putting fuel into a monster compound interest locomotive. You should want to feed it with as much fuel as you possibly can, because whatever you put into it, you're going to get way more out of it. At this
And
point,
as I always like to say, Logan, look, at year 20, isn't this like a dollar for dollar match?
I hate comparing it to a 401k because
I know,
that doesn't sit right with me. That just
but the
doesn't sit right.
concept of the dollar for dollar match, though, if you put 10,000 in, Penn's, and this is a Penn Mutual illustration, Penn's going to give you
Year
another
20.
dollar,
Year
right?
20, you pay in a $10,000 premium, and your cash value grows by $23,000
So it's
in
over
that
a
same
dollar
year.
match.
So if you pay me $10,000 and I give you right back $23,000 more than you had, is that a cost?
I tell you, it's too good to be true.
Yeah, so would I. So would I. So again, we paid $30,000 total. That's it. Okay, and we locked in a $781,000 death benefit. Okay, but wait a minute. That death benefit keeps growing. Every year it gets better. Let's look at age 65 because this guy, his term would expire at age 65. Okay. We have $1.2 million in permanent death benefit that we can access if we have a long-term care need or a terminal illness. We have $586,000 in cash value that can continues to earn tax-free with no market risk. And if we use that money, it keeps earning for us even while we're using it. Right?
Yeah. And I know you don't like to compare it, but don't we have a match now of over for every dollar you put in, you're getting a match of what, $2.50 for every
Yep.
dollar
So
you
at year 30, you paying a $10,000 premium, your cash value grows by $37,000. So this is why you want that premium paying period to be as long as possible.
I
Long as
agree.
possible.
I
We've got to
agree.
get away from this mindset of, oh, I don't want to pay, I want to stop paying. No, you don't. This is not a payment in the sense that a term payment is a payment, right? When you pay your homeowner's insurance policy, when you pay your car insurance policy, when you pay your term policy, right? You don't have the same benefits. Okay, here you're feeding that compound interest locomotive, and compound interest gets better every single year. Okay, so you want the longest premium paying period possible. Okay. If you do a short pay whole life policy, what you're doing is you're killing the best years of the policy. You got that locomotive going, right? It's really hard to get a locomotive going, but once you get it going, man, do you want to feed that beast, right? Same thing here. Okay.
And
So
you're going to maximize the death benefit too. Look, I've written some 10 pays in the past that actually paid out in claims. I've mentioned this before.
Mhm.
If I would have had it done it again, I would have probably written them a whole life at 100. okay, versus a 10 pay, because I'm proud that the claim paid out, but it wasn't nearly. Now there's a place for a 10 pay or 20 pay. If you're doing, like, if we're taking an IRA and we're taking, systematically, what I say, taking forever taxable money and turning it into never taxable money, there's a reason to do a short pay for that purpose. Okay. That's not what we're talking about here. Right. But anyways.
Yeah, we're talking about the structure of whole life, and the structure of whole life is it gets better every single year, no matter how you design it. Doesn't matter how you design it. It always gets better every single year, because the most important element in compound interest and in whole life insurance in particular is the passage of time. Okay. So those first 3 years were the painful years where we paid this $30,000 in. We have a permanent death benefit, okay, but we don't really have a liquid component as much, right?
Yep.
Okay. So I'm going to try and, well, I'm not going to try to do this too much on the fly, but what we're really saying, Peter, is we paid $30,000 over 3 years. Okay. That was really the cost to us, as we've shown, because of the way that we can utilize the cash value. There really was not a cost beyond that. Okay. So assuming we live 30 years, which is pretty likely, we paid in $30,000 total. And we have a permanent $1.2 million death benefit and $586,000 of cash value. Peter, where can you invest your money without taking on market risk and turn $30,000 into $586,000 with a leveraged $1.2 million death benefit?
I don't know. I've never seen anything else. I mean, unless I can find a little leprechaun around here that can find me a pot of gold.
Yeah, yeah. The other thing I want to point out too is what we call non-forfeiture options. I don't recommend using these, but it's good for people to know this because it helps put people at ease. Because everyone, I think, when you first start paying premiums in your whole life policy, it feels like a cost. It feels like it's money leaving your personal economy, when in fact it's the opposite, right? And so we talked about why you would want the longest premium paying period possible. However, you have, if you never want to pay another dime in premiums, you have options. Okay. So at this point, at any point in the policy, you have a contractual right to take what's called a reduced paid up, which means, let's say you're age 65, you want to retire. Okay. And you never want to pay any more into this policy. I would stop you and say, you don't understand what you're doing here. You want to pay that premium. But if for some reason you didn't, okay, you could take a reduced paid up, which means you're telling the insurance company, I never want to pay a premium into this policy again. They say, okay. You see a one-time reduction in your death benefit, but no reduction in your cash value. And then your death benefit and cash value start going up again because you're still being paid dividends, but you cannot pay a premium into the policy anymore. So all these premium payments after you take a reduced paid up become zeros, which I would argue is a bad thing, but
You
that
could.
kind of
The
puts people's
person's,
mind at ease, just to know, hey, you have options.
yeah, and their
With
financial
term, your only
situation.
option is surrender the policy if you don't want anymore. That's your only option.
Right. I mean, people's financial situations change. Maybe there would be a reason for it, but it's more flexible than what people realize. They see that sometimes and they think that they're, oh my gosh, I'm locked into that forever, right? You're not.
Right, right, right. Um, and it's
And by the
funny
way,
too.
once again, going back to, in the next 30 years, is it likely that there will be some volatility in the markets and an opportunity to actually take advantage of it? And we can't even project out on an illustration over 30 years how many times you would be able to access your cash value to take advantage of this stuff. We can't project that, right? Because we don't know when it's going to happen. That's what makes this stuff so darn good. Oh my gosh, I get excited just looking at this, thinking about, we all know there's going to be all kinds of issues in this country. I mean, look at it. We could be going into World War III right now, right?
Yeah, but yet when they look at a retirement account or mutual funds, they can confidently project out for 30 years that they're going to get 12% returns, and
Yeah.
the numbers will look amazing.
Go ask the Japanese
That's
about that. Go ask
yeah,
the Japanese
that's
about that.
Well, that's ridiculous. What about fees? What about taxes? And we're not taking into account any of that. What about the fact that we know the market is going to go down at some point in time? Like it's going to happen probably multiple times. What happens if you have a critical illness, a chronic illness, right? Any number of needs where you all of a sudden need to raid that money. And now your plan is totally interrupted. Here, when you use the money, you don't interrupt the plan, right? Because of the policy loan feature. So in this case, we have $586,000 in cash value. You know what? We can use that to pay premiums if we want to, right? That's enough to pay the premiums, more than enough to pay premiums for the rest of the life of the policy. And your cash value will still grow because the cash value growth you're getting is more than what you're withdrawing from the account to pay it with, right?
Yeah, the dividend's higher than the total premium, right?
Right. Right. So to Peter's point, we could also, in addition to using the cash value, that's actually technically a separate option, is we can tell the insurance company, just use the dividend to pay my premiums, right? So here we're getting the dividends. They'll use the dividend to pay that premium. And since the dividend is more than the premium, you can do that.
Yeah.
You
Now
can do
that'll
it.
affect your cash value, of course, in the long run, but you know,
But it's still be going up, right? It'll still be going
right.
up.
It's still going to go up. That's the beautiful thing. Once
Right.
again, there's another option you have. So you can keep on paying the premiums. You can reduce your total death benefit, go that route. You can have, you can access loans. You can have the dividend pay the premium. You got so many options. It's amazing.
Right. And keep in mind, this dividend does not reflect the total amount your cash value is growing. Okay. You're being paid dividends and interest. That's important. Two different things. Some people who don't understand whole life confuse the two. And some people loosely talk about the dividend meaning everything you're being paid. Okay. So you can see the dividend is 19,000, but your cash value actually grows by almost 40,000. Okay. Because you're being paid in two different ways, dividends and interest. Okay. The interest is the part that's guaranteed. Dividends are not. And by the way, we're projecting out the lowest dividend in recorded history for this particular company. I think that's pretty darn conservative relative to what they'll project out with mutual funds and retirement accounts, right? There was something else I wanted to say on that, but I lost it.
So go to age 85. Let's just say they're roughly when they're going to pass away.
Yeah. So age 85, life expectancy, right? So here we have it. They're being paid $62,000 dividend. Cash value grows by 90,000 in that 1 year. We have a $2.2 million permanent death benefit, which can be used in the likely scenario of a long-term care need, right? So about 70% of people, in 70% of cases, if you have a married couple, right? If they both live past the age of 65, which is pretty likely, 70% chance they'll have some form of long-term care need, which can get pretty expensive, which can blow a hole in your financial plan, which brings in all sorts of medical and non-medical related expenses. We can use that death benefit to pay for long-term care, right? It's called a chronic illness rider. Same thing if we have a terminal illness diagnosis.
Or they could just even use just access the cash value, right?
Right. And it's all tax-free and creditor protected. If you get sued, right? Creditors can't come after this. Okay.
I mean, looking at that age at 85, the dividend is 62,000.
Right. And your total cash value is 1.8 million.
Yeah.
And keep in mind, the total cost of this policy was $30,000. That's it. The net out-of-pocket premium outlay to you was $30,000. It's not $10,000 a year up to age 85. Okay. That's the premium amount, yes, but that's not the actual net cost to you. The net cost to you for this policy was $30,000 over 3 years. Period. End of story. Because from that point on, every time you pay $1 in premium into the policy, your cash value grows by more than $1. So how do you consider that a cost? I don't understand. To me, I agree with you, Peter. The more I look at this, I'm like, this is way too good to be true. I mean, this can't possibly be right. These numbers have to be wrong. How did I leverage $30,000 into a permanent $2.2 million death benefit, of which $1.8 million is liquid? I paid no taxes and I took on no market risk. And I was protected in the case of death for long-term care that whole time, and I can borrow against this pile of cash while it keeps earning for me that whole time.
I'm
How
guessing
is that
that's
even possible? I mean, how is that even possible? I don't understand.
I'm guessing that's why Ernst and Young says you got to have some of this in your investment portfolio.
Yeah, here's the thing. Mathematics is really, really powerful. When you get mathematics working in your favor as opposed to the bank's favor, boy, it's really powerful. It's
Yeah.
really powerful.
So when all these people try to trash this stuff, and I just say, so you're telling me one of the top 10 largest accounting firms on the planet says this stuff is good, and you're telling me it's trash? You're telling me you're smarter than Ernst and Young? Seriously? Come on.
Yeah, and it's interesting to me. One of the things I've noted, tell me what you think about this. The more formal financial training and formal financial titles a person has, the less they actually know about finance. It's sort of like the ivory tower syndrome, um, where they get trained in a certain way, right? And so then they just get this tunnel vision, right? I've seen this a couple of times, and I see this throughout where people will start arguing and they'll start throwing out their credentials. And I'm like, wait a minute, a credential doesn't substitute for an argument, right? Okay, you might be a CFP, you might be a fund manager, you might be very wealthy, you might have all these different things, but that's not an argument. And when you bring up your credentials, it tells me you have no real argument, right? So what most of these people lack is plain good common sense because their training has focused them on things like return on investment, which is a completely irrelevant metric. So if you're myopically focused on the internal rate of return on the cash value in whole life, and you compare that to your total fantasy 12% return in mutual funds, of course it looks bad. Of course it looks bad. So yeah, I don't know if you had a thought on that, Peter, on how the more credentials and formal financial training someone has, the less they actually know about real financial principles.
Well, it's true to a certain degree. Now I have credentials. Do I hang everything I have on them? No, but I what I was trying to, I think experience and actually not having this, like you said, this tunnel vision. Okay. Cause there I was in 2002 being taught that, at a financial planning firm that you're better off buying term and investing the difference. Right. And it would be very easy for me over the last 22 years to just be like that. But it's, you know, I've experienced a lot of things in my career, and I've seen that that's not true, and you have to have a more holistic approach to things. Okay, so I like to use third party, what I call non-biased resources in a way, because we are in a way, Logan, me and you, I consider us to be biased, right? In a way, because if you buy from us, we get compensated for it. The financial advisor that you give $1 million to, he's biased. He'll make a fee off of it. That's why I like to use these third party, Ernst and Young. You hear me talk about it all the time. These guys are not selling investments. They're not selling annuities. They're not selling life insurance. And what Ernst and Young said in that study was that if you want to maximize retirement income and legacy at the same time, at least 30% of your portfolio, their number was 30% cash value life insurance, or of your portfolio should be in cash value life insurance. Okay. 30% annuities and then 40% in your other investments. I, so I don't know what else to say. It's my experience that having that tunnel vision, as you said, can be very harmful. Just like I think our first financial malpractice video we did talking about that client or prospect you had that had this advisor that everything could be fixed about return of investment, right? I'm sorry, that's just so wrong. I
Well,
don't know what else to say.
yeah, cui bono is always the question asked. Cui bono, who benefits, right? So I'll bring up someone that I'm not a fan of. I'm not at all a fan of the white coat investor. He's an avowed hater of whole life and he trashes it all the time. He doesn't understand it at all. Okay. But I do agree with some of the things that he says. One of the things that he points out is that if you're working with a financial professional of any stripe, it's important to know how that financial professional is compensated. And I agree. And of course, not to say making money is evil, making money is good, okay? But how you make money, right, is important to know, right? And so he points that out, and I agree with him, right? So as an example, there was a fund manager who was posting some comments that revealed tremendous ignorance about even those the most basic financial principles. And of course, the fact that he had to bring up that he was a fund manager makes me suspicious immediately. Like, why can't you just make an argument? Just explain your point. You don't have to bring up the fact that you're a fund manager. That's just bragging. Okay. But what is the job of a fund manager? Is it the job of a fund manager to really understand financial principles? Right? Is it the job of a fund manager to give really sound, good financial advice? Is it the job of a fund manager to optimize your personal financial picture? No. The job of a fund manager is to attract as much money in assets under management as possible and keep it locked in his fund for as long as possible. That's his job. That is his job. That is how he makes money. Okay. And so as a result, his view of the world is colored by that, right? So this is where this whole return on investment metric comes from. Because if you want to attract assets under management and keep that money locked up in your fund, in your jail for as long as possible, you can't give anybody anything real or tangible, right? So the way you attract that money is by advertising a high projected return on investment, right? And so as a result, it's kind of difficult for someone like that to really understand a lot of these other concepts like cash flow, opportunity cost, right? Taxation, things like that that are much more relevant to the average person, the things that people don't typically consider or see, right? So it's the four rules of financial institutions, right? Rule one, give us your money. Rule two, give it to us on an ongoing, systematic basis. Rule three, let us keep it for as long as possible. And rule four, if and when we give it back to you, we're going to give it back to you as slowly as possible, or maybe not at all, right? Those are the four rules of financial institutions. So, and it's not to say that any of these people are bad people. It's just important to keep in mind, how that incentive structure works. And yeah, to Peter's point, we're biased too. Like, I'm not pretending to be an objective, unbiased source, right? But you should be just as skeptical when you're talking to these other people, these purveyors of approved wisdom, right? And see how they're being compensated, right? And just understand that. That's all right. They're biased too. A lot of what passes for financial advice and financial research is really just marketing and advertising for the standard Wall Street vehicles, right?
Right. And that's where I probably talk about it too much, but I just love that Ernst and Young study so much because, I think I think people see social media and all this stuff that we talk about, right? And they get so confused. And then they end up really not doing anything. And then they might end up doing a suboptimal strategy because they're so confused. Where I would much rather see, if you got $1 million and 300,000 of that is in cash value and 300,000 is annuities and 400,000 in investments. I'm sure you'd agree with me, Logan. I'd be much happier seeing that than seeing $1 million in investments, right? I mean, so that's why I always reference that in a way, because could we make an argument that all $1 million should be in whole life? We could make an argument. You'd probably make a heck of an argument for it, right? But at the same time, I'm okay with divvying up a little bit because what are we seeing? We're not seeing a lot of times 30% of the portfolio in whole life. We might be
Yeah.
seeing 1% or 3%. And that's the issue I have. And I think that's where I like social media. Me and you are on social media. But my gosh, some of the stuff that we see is just, as we call it, it's financial malpractice, and it's really tragic because it's really costing the American people not only just money but stress. And let's face it, stress kills, right?
Yeah, yeah. Like I keep saying, it's all about cash flow. It's all about cash flow. So if two people have the same financial strategy, one of them earns $100,000 a year and the other one earns $500,000 a year, well, which of them is in a better position, right? So it's all about optimizing your cash flow, maximizing the amount of money you have coming into your personal economy and minimizing the amount of money you have going out from your personal economy. And doing, among other things, the infinite banking concept, velocity banking, a lot of the things I talk about, just optimizing what you're paying across your different insurance policies so you can pay less or pay the same amount but get better coverage, all that stuff, right? Has nothing to do with return on investment, right? When you pay your money into your homeowner's insurance, what return on investment are you getting? Well, you're not getting a return on investment. Is it benefiting you financially to have homeowners insurance? Absolutely. Absolutely. Right. You can't measure financial value in terms of return on investment. We have to get away from this metric. Okay. Especially in retirement. It's not about the size of your nest egg. It's not about what return on investment you're getting or hoping to get. It's about how much income do you have, right? It's all about generating that safe, reliable, passive income, right?
Yeah.
And the question, as always, is as compared to what? As compared to what? So they always, to your point, Peter, they put whole life up against a unicorn scenario where you're investing, quote unquote, i.e., buying mutual funds and getting this 12% rate of return, right? Of course, they're not taking into account all the other benefits of whole life. They're just myopically focused on the cash value, but they're comparing it to a unicorn scenario. So, well, that's not a fair comparison, right? How much of that 12% return that you're projecting is guaranteed, right? That would be a fair comparison. Let's compare the guaranteed rate of return in whole life to the guaranteed rate of return in your mutual funds.
Yeah. It reminds me,
Mutual
Logan.
funds, it's negative 100%. You could lose everything.
Yeah.
Everything, all of your money is at risk. All of it. I'm not suggesting it's likely that you'll lose everything, but it is possible in theory. Likewise with whole life. These companies have paid dividends every year straight for over 100 years. So I don't think it's likely that you'll only get the guaranteed rate of return. In fact, it's never happened. They've done better than the guaranteed rate of return every single year. Okay, so I don't think that's likely either. These are equally likely scenarios, right?
Yeah. You know what it reminds me of? It reminds, I love history, right? Military history. How many, how many generals walked into a battle? They had the best battle plan ever. And the minute that the shooting started, that plan went right out the door, right?
Mm-hmm.
I mean, that's what we're talking about here. The investment side is like this, like you say, it's the perfect battle plan. Our three divisions are gonna attack right here. We're gonna push through, and the whole army's gonna surrender. That's kind of like what they're saying. That's not what's gonna happen, probably, right? And
Right.
then
And
what?
no contingency plan whatsoever, right? Again,
Right.
I'm not saying these things are necessarily likely, but what if the market crashes? That probably will happen sometime over the next 10, 20 years, right? What if you get cancer? What if your parent goes into long-term care and you have to help them, right? What if you lose your job? What if you become disabled? They're not likely, but you need to have a plan that at least takes that into account, right?
Yeah. What if we become Argentina, or at least what Argentina used to be with the inflation out of control, right? I mean, up until Javier Milei getting elected, they were looking at like 70% inflation. If you do the rule of 72, that would mean you would need to double your money like every year in order to have the same standard of living. Could you imagine that?
Yeah,
Crazy.
it's not likely that your home is going to burn down, but
3%, right?
you
3%
still have
chance.
homeowners insurance, right? So if we take what these financial advisors, investment experts are saying to their logical conclusion, when they talk in terms of probabilities, what's likely, then you should never own any form of insurance. By definition, insurance is very unlikely to pay out a claim. Otherwise, the whole business model would break down, right? So you shouldn't have homeowners insurance. Take that money that you're throwing away on homeowners insurance, put it in the market instead because you get a better return. Take that money you're spending on car insurance, stop wasting it. put it into the market because you'll get a better return. Take that money you're wasting on life insurance, right? And put it into the market because you're going to get a better return. As one person pointed out, if you take the logic of buy term and invest the difference to its conclusion, you shouldn't even buy term. Just invest
Right.
everything.
Right.
You'll get a better
Yeah,
return,
it's a good point.
right?
Real good
Just
point.
invest everything. Put everything into the market and leave it there forever. That is the logical conclusion of what they're saying. If you're going to play probabilities, you shouldn't have any contingency plans. You shouldn't have any insurance because it's unlikely that any of those things are going to happen, right? It's the rough equivalent of going into a casino and playing the odds. If you're smart, if you're a professional, you can play the odds in gambling, right? And you can set yourself up in a scenario where you're likely to make money because you know how to play the odds. But that is gambling. Do you really want to gamble with your financial future, right? Do you want to have to hope that you can retire, or do you want to know that you can retire where you have a guaranteed result? You've already won the game, right? That result in whole life is guaranteed. You've already won. Maybe you won't live to see it. You might die prematurely. Okay. But that result is guaranteed.
Yeah. I was actually asked by a very yesterday I was meeting with a prospective client, and he's just a amazing individual, and he's done some really good planning, and he asked me a question: what's the difference between IUL versus whole life? And or he asked what the performance would be in the long run, right? And as a disclaimer, I know, Logan, you only do whole life. I do both. But I said, you know what the difference is? I said the whole life is a sure thing. And I said the IUL might beat the whole life potentially, but I need you to tell me over the next 40 years what the index returns on that IUL will be. And he goes, well, I can't do that. I said, do you see the beauty of whole life? Right? That's the difference there. And I don't mean to change subjects, and I know we got to wrap up here, but that whole life that's the beautiful thing about whole life. Once again, do I own more whole life than IUL in my own personal portfolio? I do, because I just like the sure thing.
Yep. 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 And we're not against speculating or investing. It just needs to go into its proper place in your financial structure. I don't like the word portfolio because then we're thinking people are thinking in terms of like investments. And I know you mean it more broadly when you use that word, but I like to think in terms of cash flow. As Denzel Rodriguez says, your money has to move. Your money has to move. How is your money moving? If we're talking about portfolio, you're talking about where's your money sitting? Well, no, you don't want your money to sit. How is your money moving, right? How are you increasing your income and decreasing the amount of money in decreasing your outflow? Maximizing the amount of money that's flowing to you and minimizing the amount of money that's flowing away from you. Infinite banking, either on its own or combined with velocity banking, is a way of optimizing that, right? Without really changing anything you're doing. It's a way of maximizing the amount of money you have flowing into your personal private banking system in minimizing the amount of money you have going out, meanwhile earning on all of it, right? Notice I said nothing about return on investment, right? We're not taking on risk. We're not telling you to change your lifestyle. We're focusing on what really matters, which is cash flow. Cash flow. As Robert Kiyosaki says, it's not about return on investment. It's all about cash flow.
Yep.
So that went a lot longer than I thought, but that was fun.
Yeah.
Anything you want to say in closing, Peter?
No, I think I'll just say, look, once again, after what we chatted about, there's a place for term, there's a place for whole life, there's even a place for other financial products out there. But you really got to know the ins and outs. And once again, the whole beautiful thing, if you can remember one thing, the beautiful thing about whole life is, as Logan has said, is once you set it up, it's going to get the job done. And I just can't stress enough. That's the beautiful thing about whole life. It's the
Yep.
greatest non-managed asset ever invented by the human mind. It truly is.
Another time we will have to talk about the enormous psychological benefits of having certainty in your financial plan. People ignore the psychology because they're just looking at numbers on a page and they're looking at a plan on paper, right? That's like putting together a diet and exercise plan or a business plan. Anyone who's run a business knows this, right? Or to your point, Peter, a military plan, right? And there's a huge psychological component to it, right? Huge. So having whole life and other forms of very robust insurance and protection in place gives you the peace of mind to make good decisions and to avoid pitfalls, right? Whereas when you're plowing a lot of money into the market, that puts enormous pressure on those assets you have in the market where they have to perform, right? And now you're feeling the psychological pressure, and now you're not making the best decisions, and you're taking on more risk than you should be to chase after that ephemeral return, right? And as a result, you run into problems because everyone's going to brag about that one investment that got them a great return. They won't tell you about their losers, but they'll brag about that one investment, right? Nobody brags about the fact that, oh, we had this tragic health thing happen to us, but because we had a whole life, we could use a death benefit to pay for it, right? Or because we had robust insurance. Nobody brags about that, but that's a far more likely scenario, and one that's far more likely to blow up your financial plan that you need to be prepared for. But nobody brags about the defense of their model. They only brag about the offense. But over the long run, it's the defense that wins. It's the defense that wins.
What do they say? Offense wins games and defense wins championships.
100% correct.
All right.
Warren Buffett, greatest investor of all time. Like, if you want to invest, why don't you listen to the actual successful investors? Are they telling you higher the risk, higher the reward? No, 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 no. They say exactly the opposite. Warren Buffett. Rule one of investing, never lose money. Rule two, see rule one. So, and I did want to mention briefly, I am still digesting it, but I was watching an interesting presentation on the high rate of return in a whole life. And so it's like, hey, look, these numbers people like to throw about return on investment. Even though I think it's a useless metric, if we're going to use it, we have to use it in an honest, consistent, disciplined manner, right? So we have to measure it properly, okay? Taking into account everything like taxes, fees, inflation, volatility, risk, right? All that stuff. And so they asked the question of, instead of just myopically focused on the internal rate of return on cash value in whole life, they ask, what return on investment would you need to get in some other asset in order to get all the same benefits of whole life, which is a lot more than just how the cash value grows, right? The number they came up with was 17%. So if you're paying $10,000 a year into that whole life policy like we showed, okay, and you want to try and get the same benefits by taking that $10,000 a year and putting it somewhere else, you would have to get a 17% rate of return in order to get the same benefits.
Wow. I'd like to see that. That would be an interesting video. Let's see that. I'd like to see that breakdown.
Absolutely, absolutely. We'll do that at some point in the future. But it's taking me work because guess what? Unlike those guys, I'm actually putting together a proper financial model. Okay, because I know how to do this. I did it for a living with big time CEOs of big time companies, right? I actually know how to build financial models. Whereas these guys, their supposed models are just sales and marketing, and they're pretty easy to take apart because they make ridiculous assumptions. So, all right, Peter, thanks so much for your time. Always fun. And we'll look forward to the next one.
All right, Logan. God bless. Godspeed.
God bless everyone.